Good day, friends. In the subject of personal financial planning, investment planning is a very important and integral part of the personal financial planning. And when we talk of investments, in my previous lectures on investments, I talked about the various instruments, various asset classes of investment, and each asset class has its own merits and demerits. When I talk of merits, means the amount of return which is expected from an asset, and the risk associated with that asset differs from asset class to asset class. So in this very lecture, we will be talking about return and risk. That what is return, what is exactly return, what are the different type of risk that is associated with the investments. When you make investment in a particular asset class, what are the associated risks in that asset, or especially if we talk in context of the equity, because equity is also a very important investment class. So what is return, what is risk? This is the subject of discussion in this very lecture. When you talk of return, I would say return is the motivating force and the principal reward in the investment process. Any investor, when invest in any asset class, whether fixed income securities or the variable income securities, means when I talk of the fixed income securities, mean in terms of the bank's deposits, post office deposits, PPF, government securities, debt. And when you invest in the variable income securities in the form of the equity shares, in the form of gold, in the form of real estate, right? Then the return, the reward which you expect, the increase in the wealth that investment will create, that is what the return is. Supposing I invest 1 lakh rupees in a particular asset, and after 5 years it gives me 1,20,000 rupees. That is, if I am able to sell after 5 years in 1,20,000 rupees, it means this 20,000 rupees is the reward, it is the return of my investment which I made 5 years before. So basically the return means the reward that you expect from the investments. When you talk of return, it can be in form of actual return, when we call it realized return, or expected return on probability distribution, or it may be you call it holding period rate of return. Actual return means when you actually disposed of that asset and the money you realized by selling that asset, the difference between the selling price and the cost price. When I talk of the cost price, it includes the maintenance cost of that asset, right? So when I talk of the selling price minus the associated expenditure in selling. So means the net inflow of cash, net inflow which we received minus net outflow. That difference is called the actual return or realized returns. So it refers to the return which has already been earned or realized. When I use the word realized, it means after selling of that asset, the difference between the selling price and the cost price is called the actual return. On the other hand, expected return means that any investment which any investor makes, it presumes that there will be certain amount of return, certain percentage of return, if I talk in terms of the percentage, that investment will give to him or her. That is called expected return. And there are different scenarios of the return. Means there are different probabilities. If everything goes well as per the expectations, this is the probability of that I will be getting this much return. If things are normal, that I am expecting that what are the chances that there will be normal situation, I will be getting normal return, normal expected return, the probability you assign with it. If the situation worsens the way you expected it, the situation or the investment doesn't give you that amount of investment, what is the probability that you will get that return? So there are different situations, and in different situations you assign certain probability of that situation. And what is the associated return with these type of different situations? That is called, and if you multiply the expected return with the probability of happening that event, make the summation of it, that will be your expected return. So this is basically, there are two types of return. One is called realized return, the other is called expected return. We can also talk of holding period rate of return. Holding period rate of return means, if I talk in terms of percentage, that if you hold an asset for a particular period of time, say you are buying an asset and disposing it of after 10 years, after 5 years, after 2 years, what will be the return that you will get in absolute terms or in percentage terms? So holding period return, if I talk in terms of the absolute terms, income plus ending value minus beginning value. When I say income, income means over a period of time for which you have hold that asset, it may gives you some regular income or some income. Like say for example, if I talk in terms of the real estate, I have purchased a house, I have purchased some commercial property, it may be any real estate, and I let it out. So the rental income which I will be getting over a period of time for which I hold that asset, that is called income generated by that asset. Plus the dispose of value, the ending value at the time at which I sell that asset, what is the value of that asset, minus the beginning value. Divide by the beginning value into 100. That is called your holding period return. So holding period return is basically the income plus the ending value minus the beginning value. If you talk in terms of absolute value, so that is your holding period return. If you want to calculate it in terms of percentage, you divide it by the beginning value, the purchase cost you can say, into 100, then you will find out what is the return that the asset has given to you. So if I talk of expected return, which I referred earlier, expected return is calculated by multiplying the possible return with the respective probability, right? And the formula of that is expected return is equal to summation of Pi into Xi. Pi is the different probability which you assign, that this is the probability of that the return which you will be getting will be that much. So expected return is equal to probability multiplied by the return, and the mixed summation of it, that is called your expected return. Take an example and we will be able to make it more clear that what is expected return. Say we are making an investment, say let's take an example of an equity share. By and large our examples will be in terms of the equity. When I am talking of return, by and large examples will be of the equity share. There are three different situations which we are visualizing. If situation is bad, and what is the probability that the situation will be bad? Means when I use the word bad, it means not as you expect. The chances of probability of the bad situation is 40%, 0.4. The probability assigned is 0.4. And what will be the return in that situation? That is basically the 10%. If you get average return, what is the probability? Right? If the probability is 50%, and the return will be not 9%, say it will be 11%, right? And then if the situation is good, what is the probability of that? Is 0.1%, means 10% probability. And the return will be, if the situation goes well as our expected, right, the return will be 20%. So what is expected return? Simply it will be Pi. Pi means the probability of happening at different events, bad, average and good. Pi multiplied by Ti. Ti means the return, Ri you can say. 10%, 12%, not 9% which I have written here, but 12% and 20%. So if you multiply 0.4 into or 10%, 0.5 into 12% and 0.1 into 20%, the summation of it will be your expected return. So friends, in this way, that is the probability multiplied by the expected return, the sum total of it will give you the expected return. Similarly, you can also calculate the holding period return. What is the holding period return? As I just told you, that holding period return is the return which you expect if you hold that asset over a period of time. The return which we get is called holding period return. The example which we have taken is Mr. X purchased shares in a big blue fund 4 years ago, means is the name of a fund, for rupees say 5,000. Shares are worth rupees 10,000 today. right? If you take the current market value of that fund, it is 10,000. And the person also receives 250 rupees in distribution income each year for 4 years. That is in form of, you can say, dividend or return which you getting regularly is 250 rupees on an annual basis for 4 years. So what is the holding period return? So what is the first is income plus end value minus beginning value divided by beginning value into 100. This formula we have discussed earlier. So what is the income that is generated? 250 into 4, because the holding period is 4 years. The return every year which you get is 250. It is not necessary that every year you will be getting the same return of 250. It may be 200, 250, 300 rupees, 350. Whatever the income stream is, you make summation of it. Here for simplicity purpose, we have kept the income constant, that is 250 rupees for 4 years. So that comes to be 1000 rupees for 250 multiplied by 4. So income is 1000 rupees plus what is the selling price? Selling price is 10,000. What is the purchase price? 5,000. So 10,000 minus 5,000 plus 1,000, that comes to be 6,000. So the income that you generate by holding that asset is 6,000. Your purchase price is 5,000 into 100, it means 120%. So if you hold this asset for complete 4 years, this will give you the return of 120%, right? So this your investment of 5,000 rupees will become 11,000 rupees, right? So it gives you a return of 120%. Now, after talking of return, we all know that every investment that an individual makes, it is subject to risk. What is risk? Risk is the uncertainties associated with the return that we expect from an investment. Means whatever return we are expecting, it may come, it may not come. That is what the risk is. The uncertainty associated with the return is called risk. So risk is defined as variability in expected return. The variation that takes place in the return, that is called the risk. So risk measures the uncertainty of receiving return according to the expectation of an investor. I buy the gold that each one of us is saying, every person in the market is who deals in the commodity market is expecting that the gold and silver prices in the time to come will increase world over. It is an expectation. It may come true, it may not come true. If the gold price is today 60,000 rupees per 10 gram and people are expecting it will be 70,000 rupees, it may become 70,000 rupees after 2 years, it may not become, right? It may remain only 65,000, it may become 55,000 rupees. So variation is from 55,000 to 70,000 rupees or any sum of money. So even the value of the gold may fall after 2 years. We will find that the value of the gold may not be even 60,000 rupees. It may be 55,000. It may be 50,000 rupees. So this variation, this uncertainty, because I am investing in the gold not for the ornament purpose, but for the purpose of pure investment, that this investment in gold will give me good return. Gold is in more demand world over. The prices are going up, so I am expecting that it will continue to go up. With this intention, with this purpose, I am making the investment so that it can give me good return. But what will happen after 2 years? I mean, you are not very sure. It may be 70,000 rupees as you are expecting. It may be 55,000 rupees. So this variation from 55,000 rupees to 70,000 rupees means your return can be negative to the extent of 5,000 rupees and your return can be positive to the extent of 10,000 or any sum of money. So this variation in return is nothing called the risk. This is the risk associated with any investment. And friends, any investment which you make, the associated risk is always there. The degree of risk may vary from asset class to asset class, but risk is there. No asset in the world is risk free, right? So we say every asset, we say treasury bonds, the bonds issued by the government of India, that is RBI, are almost considered as risk free. But suppose in a country, I'm not talking of India, in other countries, suppose the government fails or government fails to make its commitment financial commitments. So it may not able to pay you in time. That is what the risk is. So every investment that you make, it is subject to risk. The degree of risk may vary, right? So it may be less, it may be more. Like when we make fixed deposit, we presume that there is no risk associated with the bank fixed deposit, that the banks are not going to fail. But when you invest in real estate, when you invest in gold, when you invest in equity shares, you know it, that people know it, that the asset class is risky in the sense that the value keeps on fluctuating. The prices keeps on fluctuating. It may increase. What will be the extent of increase? You are not sure. It may decrease also, right? So this change in the price is called the associated risk. So in investment, risk has positive relationship with the return. When you are generalizing it, we say higher is the risk, higher is the return. Normally, when the risk is low, the return is also low. So now, after talking of what the risk means, risk, as simply I said, is the variation of the return. The variability of the return is called the risk. The uncertainty associated with the return is called the risk. Risk can be classified in two broad categories. One is called systematic risk, other is called unsystematic risk. Any investment that an individual makes is accompanied with these two types of risk, systematic risk and unsystematic risk. Let's discuss what the systematic risk is, what are the causes of systematic risk, what leads to systematic risk, and what is unsystematic risk. Let's first talk of the systematic risk. Fluctuations in the return of stock, if I am talking in terms of the equity market, fluctuations in the return of stock that occurs due to macroeconomic factors or extraneous situations outside the control of the company is known as systematic risk. Means there are certain things which are there in the environment, outer environment of your organization. If I am talking of equity shares, there are certain things which are beyond your control, which are extraneous in nature and which are outside the domain of the company. That whatever is happening in the economy will affect the company. It may be because of geopolitical risk, it may be because of the market fluctuations, it may be of various reasons. I'll be talking in detail, but there are certain factors which are beyond your control, which are exteriors of nature, which is outside the company, which is in the environment, right? So this fluctuation in the return that takes place due to macroeconomic factors which are beyond your control, that is called systematic risk. These factors could be political, social, economic, and because of the general markets. General markets means fluctuations in the market. See, when there is a change in the government, or suppose there is established government in the country, and because of one reason or the other, there is a political upheaval in the country and the government becomes vulnerable, means subject to change. That is, the stability of the government is in challenge. In such a situation, the stock prices or the prices of the different asset class gets impacted by it, right? So this is basically systematic risk. Different companies which are operating, different business houses which are operating, or different asset class will be impacted by this systematic risk, which is not within the control of the company, which is the control of individual. This is because of macro factors of the environment. It may be social reasons, it may be economic reasons, right? Supposing we are talking of that in America, in Europe, there will be recession. So if there will be recession, if the case is so, certainly it is going to make an impact on the different economies of the world. And all companies will get affected by it. It is nothing but systematic risk, right? So the factors which are relating to political reasons, social reasons, economic reasons, general fluctuations in the market, these are called systematic risk. Different companies, if I talk in terms of the equity shares, are being affected by it. The degree may vary, but by and large, all companies are being affected by it. And this risk, systematic risk, is called non-diversifiable risk. Means they are of general nature. By holding different equity shares in your portfolio, you cannot diversify this systematic risk because every company will be affected by the systematic risk. That's why we say this risk is also known as non-diversifiable risk or general risk. One very important measure by which we measure the systematic risk is called beta. We'll discuss it later on when we will talk of the measurement of risk. So, beta measures systematic risk. The other type of risk is called unsystematic risk. Unsystematic risk means it is basically company specific risk. It is basically that particular asset related risk. So, fluctuations in the return of the stock arising due to microeconomic factors is called unsystematic risk. I mean, this is diversifiable. Unlike in the systematic risk, which is non-diversifiable, unsystematic risk is diversifiable. Diversifiable means that if I talk of equity, if you want to diversify your risk, what you can do is you don't put all your investment in one equity, one company share, but what you can do is you make your investment in different companies of different industry, so that if one industry is being impacted more, the other industry may be impacted less. If one company gets trouble, the other company may not get that trouble, right? So the risk will be diversified. So this is basically diversifiable risk. So these factors exist within the company and can be avoided if necessary actions are taken. What is the necessary action? Means that you can manage within your own company, because these are to some extent controllable factors which corporate houses, which the company can manage on its own, and these are also diversifiable risk. So known as diversifiable or specific risk. This risk can be reduced by holding a diversified portfolio. And what is this diversified portfolio? Means instead of making investment in one equity, if I talk of the portfolio, then you hold different equity shares of different companies of different industry, so that the risk is being balanced. If one company is not able to perform well, the other company may perform well and your return will be average, right? If one industry is not doing well, the other industry may do well, right? So your performance may be impacted by it. So these are the basically two types of risk associated with any investment. One is called systematic risk, other is called unsystematic risk. Basically what we have to understand is systematic risk is basically non-diversifiable and unsystematic risk is diversifiable, because unsystematic risk is basically company specific. It is because of the micro factors, it is because of many of the factors are controllable to some extent. I am not saying fully, but to some extent. As far as the systematic risk is concerned, they are beyond the control of a company. It is because of exterior factors, environmental factors, and it is difficult. I am not saying impossible, it is difficult to diversify these risks, right? So these are the two types of risk. We will talk of the reasons of unsystematic risk in my next lecture. Thank you.